Okay, most inexperienced options traders don't realize that you can guarantee a loss for your account when trading covered calls without even knowing that you're doing so. In this video, our head of options trading helps you avoid this self-destructive mistake. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and now Miami, and proud to have developed numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from a pro SME trader so you can grow your trading account.
Hi, I'm Seth Freudberg, the head options trader here at SMB Capital. And given the fact that the Federal Reserve is about to launch a series of interest rate cuts to head off an economic recession, there are lots of traders and investors out there who are beginning to realize that any income that they were making from short-term money market funds and short-term bond funds and bank CDs, which have been unusually elevated over the last few years, they're about to start losing their appeal as interest rates move downward. And so those who are seeking consistent cash income are going to have to find other ways of producing cash. And many of those traders and investors have also heard that the options market might provide a solution for this problem, and that's exactly what this video is intended to cover, an alternative way to find cash income from the options market. But just like anything else, there's a right way to go about it, and there's a wrong way. And so this video is intended to teach you how an option strategy known as the covered call works. And at the same time, we're going to warn you about a big mistake that traders make when trading covered calls that can take a wonderful system for cash generation and turn it into the opposite if you don't take steps to avoid the mistake. If you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand the options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand this option strategy that we're going to be teaching you in this video. Now, when you're finished, you can just come back and watch the rest of this video. The undisputed leader of the artificial intelligence rally that's taken the market by storm is NVIDIA, which trades under the ticker symbol NVDA. And as you can see, NVIDIA has been on a tear since the fourth quarter of 2022, and by the end of the second quarter of this year, 2024, was up more than 1,000% from that 21-month period. And so let's say that on the end of the second quarter of this year, on June 28th, with NVIDIA trading at 123.62, we pulled up an options chain for NVIDIA and took a look at the chain expiring 2 weeks later on July 12th, and we went to a strike price slightly above where the stock's trading, the 124. And we went ahead and sold 4 call options at a price of 470. And at the same time, we bought 400 shares of NVIDIA for 123.62. Well, when a trader does that, buying shares of stock while simultaneously selling calls of that same stock, the trader is entering into what is known as a covered call position, because if the 4 call options, which of course represent the right to buy 400 shares for each call option at the strike price of the call, which is 124, if those 4 call options get exercised, then he'll have to have at least 400 shares of NVIDIA stock in his account to fulfill that assignment. And so the 4 calls he sold are considered covered by the 400 shares of stock that he owns. And that's why this position is referred to as a covered call. Let's be clear on the cash flow implications of what we just done. And so starting with those 400 shares of NVIDIA, well, those cost us $49,448. But then remember, we got paid $4.70 per option for those 4 124 call options, and they each represent the right to buy 100 shares of stock. And so you multiply that price times 100, and we sold 4 of them. So doing the math, you can see that we received $1,880 in cash, which nets our initial trade capital down to $47,568 when we first enter the trade. And so let's now move to the day the options expired. And as you can see, NVIDIA closed at 129.24. And so the stock closed well above the strike price of the calls, which were 124. And so at that point, those calls would have been exercised and your 400 shares would have been sold automatically by your broker to the one you sold the calls to at a price of 124 per share. And so we're going to do a short campaign of these covered calls. So we're going to start keeping track of how these trades come out. So focusing on the shares themselves, you can see that we made a small gain on those in the amount of $152. However, remember, we initially received $18.80 in premium for selling those covered calls, and so we keep that too, resulting in a gain by the end of the trade of 2032, which if you compare it to how much we put up initially on the covered call trade, 47,568, the result was a return of 4.27% in just 2 weeks. So you might think, hey, this is pretty good. If I could do that every 2 weeks, I could make over 100% return a year if you do the math. And so you figure, hey, let's trade this again. And so this time, with the stock trading at 129.24, he again buys 400 shares, sells for the calls slightly above the stock's trading price, which in this case are the 130 calls, and he sold them for 465 apiece. And so the initial cash flow looks like this, with a total outlay of 49,836, a little more this time because these shares were more expensive. And so now, moving to the day this second covered call position expired, you could see that NVIDIA experienced a bit of a pullback. And the stock ended up closing at 113.06 that day. And so in this case, because the stock closed so much lower than the 130 strike price of the call options, the options just expire worthless, which means that we just pocket the initial premium that we received selling them. And so when we add that premium to our realized profit scorecard, you can see that we are up to $3,892 so far. Okay, so we'll simply repeat the process again, except this time we already own the shares, so we don't have to buy them, and instead we will sell the 114 calls for 452, right above the stock's trading price at 113.06, expiring on August 12th. And that brings in 1808, and moving to the day that those expire, you can see that the stock sold off even further, this time down to 104.75. And so again, those expire with no value because there is no value to the right to buy 400 shares of NVIDIA at a price almost 10 points higher than you'd have to pay in the open market. So again, we make money on the calls because we just kept the cash we received originally from selling those calls. And so updating our realized gain scorecard, you can see we have now realized $5,700 exactly in gains so far from the campaign. Now let's repeat and sell the 4 calls right above the closing price. So we'll sell the 105 calls in this case and collect this time $1,900. And you'll notice, by the way, all the options prices are in that 450 to 475 range, and that's not an accident. 2 weeks out on a stock as volatile as NVIDIA, 2 weeks out the pricing is always going to be about the same near the stock's trading price because the stock is volatile. Okay, so back to the newest covered call trade that expires on August 23rd, and this time around something different happens, and NVIDIA this time rallies very strongly. And the stock ends up back at 129.37 by the time that these calls expire on August 23rd. And so because those calls had a strike price of 105, those shares are automatically sold at that price. And so let's take a look at the profit situation on those shares you sold. And as you can see, there is no profit situation because those shares were sold below the price you bought them for back on July 12th, which was a price of 129.24, if you'll recall. So when we focus on the shares we just sold, we actually take a loss, as you can see from the calculation, in the amount of $9,696. And even though we did bring in that premium of $1,900, which we did keep, we got so badly clobbered because we were forced to sell our shares at 105 because of our covered call obligation, that it wiped out all of the premium that we collected. In other words, the whole campaign became a loss despite collecting thousands and thousands of dollars of call premium along the way. And so what was the fatal mistake that we made? Well, let's illustrate how a professional options trader would have handled this same situation, and then that's going to become very clear to you. So let's think back to the time we bought those 400 shares for 129.24 back in July, after our first successful covered call trade concluded, and we had to go back and buy the shares again after NVIDIA rallied and our original shares were called away. And you'll remember that at the same time we sold 4 of the 130 calls, but the market sold off down to 113.06, so the 130 calls we sold expired worthless also. And so with the stock trading at 113.06, we went ahead and sold the 114 calls. Here, this is what it looked like to remind you. I want you to think about it. Suppose right after that happened, NVIDIA had rallied and we were forced to sell the shares at 114. Well, that would have caused a pretty big loss, wouldn't it have? Because we acquired those shares for $129.24 and we had 400 of them, so we would have taken a loss of $15.24 per share at that point, had NVIDIA rallied. So instead of taking that risk, what if instead we went ahead and sold the 130 calls expiring 2 weeks later? As you can see, those options were only priced at 47 cents because the stock's down at 113.07 at that point. But, and this is the key to this entire video, so listen up, we won't be forced to sell the shares below our acquisition price. Yeah, we'll collect much less premium, but isn't it much more important that we avoid taking that huge hit which results from our having to sell the shares at our call strike price if it's located way below where we bought the shares? In other words, if you never sell your calls below the price you acquired the shares, you can never take a loss from being forced to sell the shares if the stock bounces and the shares are called away. And so we collect just $188, as you can see, on July 26th. And you'll remember that when they expired on August 9th, the stock was trading at 104.75 when the market closed, so the 130 calls would obviously expire worthless. And updating our scorecard for the July 26th entry, we would add that 188 to the scorecard. And so with the stock trading at 104.75, whereas in the earlier case, we sold the 105 calls right above where the stock was trading, in this case, we're going to again sell the 130 calls, this time expiring on August 23rd, receiving hardly anything for it because now the stock's trading 25 points below that strike price. And so as you can see, we only collect 14 cents for each option, and so the total income for the 2-week period is only $42. And so moving to August 23rd, you'll recall that NVIDIA bounced and closed very slightly below our short calls at 130, closing the day at 129.37. And so to make an apples for apples comparison with the wrong way to trade covered calls, which we showed you before, where you forgot that locating your short calls below your share acquisition price can result in your locking in a realized loss on the shares. To make this apples for apples, we're going to go ahead and sell the shares now, which brings in a very slight realized gain of $52. And so if we update our scorecard, the campaign for the small gain on the shares and the small amount of premium that we collected, we show a final gain on this short campaign of a gain of $4,174. And so by comparison, the approach of always trying to squeeze the highest options premium out of each covered call trade results in a disaster in many cases, while the much more thoughtful idea of only locating your calls at the strike right above your share acquisition price will always keep you out of trouble with a covered call strategy, as long as the stock is a solid stock that's very likely to eventually recover from a sell-off. And so what I'd like you to take away from today's video is that covered calls can be a great way to produce cash, but you need to do it right. If you get greedy and forget about the risk of trying to squeeze every last penny out of a covered call trade and locating your short call at the wrong place, then you're going to eventually pay for it and have a very unsatisfactory outcome. Professional traders are always mindful of the pitfalls of each of their strategies. They come up with solutions for each of those pitfalls and then put themselves into a position where they can trade soundly and profitably for the long run.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.